Welcome to the Old Capital Real Estate Investing Podcast. I'm your host, Paul Peebles. With me today is Brad Sumrock. Brad, you kind of remember he was on our podcast back probably about 8 or 9 months ago. He is the preeminent multifamily mentor in the nation. If you don't know Brad, you want to know Brad and his educational successes. So welcome to the podcast, Brad Sumrock.
Hey, Paul, I'm happy to be here again. It's been a while, and I'm excited to be here with you today.
Well, thanks for coming into the podcast. I wanted to have everybody get a little bit of a better sense about who you are, what your background is. You are an apartment mentor. Can you kind of explain what an apartment mentor is and why somebody needs an apartment mentor?
Well, that's a good question, and I'll start by saying I'm an apartment investor first, and then I became a mentor. So to me, when you're looking for a mentor, you want to find someone that does or has done what it is you want to do, and then you can learn from them. So I started back in 2002 investing in apartments, and this was after being in the corporate world for 17 years, getting 2 degrees, being fired once, being laid off once. And then I became a real estate investor and an apartment investor. And after just 3 short years of investing in apartments, Paul, I was able to replace my income, which is my definition of retirement. I was able to replace my corporate income with my apartment investing income, and I quit my job. So then I started mentoring and teaching other people how they could replace their incomes through apartment investing.
So you have owned thousands of apartment units over a long period of time. So you've done very well with those apartments, and now you're able to kind of teach people how to do it. So you're not just somebody that has never done it before. You are intimately involved in apartments, in apartment education, apartment mentoring. You are the man.
Well, thank you. And, and I still buy apartments because what good is a mentor who only teaches? So in the last few years, I've sold some of my properties and I've continued to buy additional properties. Me and my investors, we currently own apartments in 5 different states. We have properties currently in Dallas, in Colorado, in Florida, in Oklahoma, and in Ohio. And I've studied the nation and identified what I consider to be some of the top markets for apartment investing. And those are some of the 5, but there are obviously more than that. And I have students buying all over the country.
So tell me a little bit about that. So you're not living in the past. You're not going off of last year's or 10 years ago. You are actually buying apartments. I think you guys just bought another building, last month or so?
That's correct. 3 weeks ago, we purchased 121 units here in Dallas, Texas area in Tarrant County.
So you definitely are on the cutting edge of what's going on. So that's great to hear. Tell me a little bit about some of the people that you've met with that are now your students. Tell me maybe 1 or 2 success stories about after they met you and how well they've done.
And I'll be happy to do that, Paul. So I've been helping people since 2005. I run my own training events and seminars. I've had literally thousands of people come to my events. And I've helped I think the last count was over 125 students have purchased apartment buildings. And I teach how to be the deal sponsor, which is the person that does all the work and assembles the group of investors and manages the asset. But I also teach investors how to be passive, okay? And a lot of people out there want to be a passive investor. And I have hundreds of students that are passive investors. They learn to become sophisticated investors and SEC compliant through my training. And so they invest with some of the deal sponsors that I personally train. A couple recent examples, I'll just think of 3. I have a young couple that just came into my training in July, and they're already purchasing an 18-unit apartment complex. And Paul, this will probably be on your database of podcasts, but this is, November 2015. They started training with me in July, so it's just been a few short months, and they're already buying their first 18-unit. I think your company is doing the loan for them. That's Tim and Angie Rackler.
Oh, sure.
I have another couple, Bonnie and Carrie Staples. They have been with me for just under a year. They've made a few offers on properties, and they are passive investors in several deals. And now they have their first deal as a sponsor. It's a 105-unit property that they're currently working on. And there's so many. Another one is Mike Parent. He's buying his first deal out of the gate, having no previous multifamily investing experience, was like a 226-unit property. And he's currently working on a 305-unit property. So I just gave you a spectrum from, 18 units to 100 units to 305 units. And all of these people have had no previous multifamily investing experience.
And that's amazing, because some of these people just wouldn't do it themselves, couldn't do it themselves, and they needed kind of help. They needed a mentor, an educator. And, Brad is not boastful, but I will tell you, Brad went to Carnegie Mellon for his undergraduate. He's one of the top, which was one of the top schools in the United States, University of Houston, for his master's. And as he said, he was in corporate America, but his passion really is education. And I say preeminent on a nationwide basis. He really is. And so if he hasn't spoken in your town, he's probably coming to your town. So you want to have a chance to visit or even watch him speak and kind of let him tell his story and tell stories of some of his students.
And I do speak all over the country. Recently, Washington, D.C., in Atlanta, Georgia, Las Vegas, Anaheim, but my weekend intensive training events I do in Dallas.
So let's talk a little bit about that, because you have one of these events coming up. It's a mentoring 2-day event. It's in Dallas, and it's on November
7th and 8th.
And is that an hour or two training, or how long is it?
Okay, so it's a weekend intensive training, and it's an entire weekend. We start Saturday, November 7th at 9 o'clock in the morning, and we finish at 6. And then we start again on Sunday at like 7 o'clock in the morning, and we finish at 5. So it's 16 hours of training. It is not a sales pitch. There are not other speakers there trying to sell you their stuff, littering your chairs with their flyers and pamphlets and handouts. I have a few people like you, Paul, that have personally done loans for me, that have personally provided multifamily services for me, that will be sponsoring the event. So the sponsors are a huge value to people that want to get started in the business, because where else can you go where you could meet a lender that does loans nationally like Old Capital, where you can meet an attorney that could support you, with your legal work on any transaction that you're doing, a company that can help you set up your IRA to invest in apartments, a company that can help you secure multifamily insurance. But those are just the sponsors. And so I teach for 16 hours. I teach all of the ABCs on how to be a successful apartment investor, why you want to look at investing in apartments, obviously why real estate is a great investment, but specifically why multifamily real estate is a great investment. I talk about the differences between multifamily and single family, the awesome financing that's available for apartments, due diligence, rehabs, and then, perhaps most importantly, where do you get the money to do all these deals? And my students are raising literally millions of dollars from other people so they can go out and buy their deals, whether it's an 18-unit deal or a 305-unit deal. And so it all starts at the 16-hour weekend training event that I call it Rat Race to Retirement. That's the name of the event, because that's my personal story. Okay, and this is my personal passion. I went from the corporate rat race to retirement in just 3 years, and now I teach other people to do that. So it'll be me teaching for 16 hours the ins and outs of apartment investing. And my goal for those that attend will be they are going to walk away with a lot of information so that they could start building their team. They learn how to find deals. They learn how to analyze deals. They learn how to do rehabs and renovations. They learn how to do everything they need to do to successfully, locate and purchase multifamily properties.
I think a couple of things that you hit upon, which are incredibly fantastic, is you do all the teaching. You don't bring in specialists or some people that only done one deal 10 years ago to talk. You talk, and you talk a little bit about raising money. When you raise money, you do it the right way. You do it SEC compliance. So you talk a little bit about exactly how to do it right.
Well, look, the national gurus that conduct these weekend boot camps, they generally promote the event and they bring in other speakers, and the other speakers are all trying to sell you something. And at my event, I am here to teach, and the the price of my event, Paul, is $47. Okay. I don't make any money doing this event. The event costs me money. We rent buses, by the way. We put everybody on a bus tour on Sunday morning, and we look at a property that I own and properties that my students bought. I provide lunch. So for $47, you get 16 hours of pure content and no BS. And you get to meet members of my personal service providers like you, an attorney, an insurance company, and you guys will get to speak for 10 minutes each, but you have nothing to sell.
No.
The only thing you have to sell, so to speak, is you provide services to multifamily investors. And so, I think that's a huge benefit for the attendees.
How many people do you think come from other places besides Texas to come watch you speak?
Well, I think that about half of the people are from Texas because that's where my base is, and about half come from all over the country. And at least that's based on the previous events that I've done. And we expect attendance of 300 or more.
Yeah, I think 300 is minimum. And if you've never seen Brad talk, it is like going to a Tony Robbins event. People are just blown away but with the amount of content that Brad puts out there. It's a great networking event. If you're even thinking about getting into the multifamily business and you want to talk with other successful people about how they did it, Brad builds the forum that you can talk with these people. And there's a cost versus a value. $47, that's nothing. The value that you get to put you in a place for maybe retirement in 5 or 6 years.
Or less.
Is really unbelievable. So we thoroughly encourage everybody to go watch Brad on November the 7th and 8th.
7th and 8th.
And if people want to get a hold of you, Brad, what's the best way for them to get a hold of you?
Well, the best way, I'm going to give them 2 ways. So the registration website is www.ratrace2retirement.com. And that's just R-A-T, the number 2, R-A-T, R-A-C-E, the number 2, and then the word retirement. So ratrace2, using the number 2, retirement.com. And there you'll have all the information you need to secure your seat. I recommend securing your seat today because the event will be full and we'll stop taking RSVPs once all the seats are taken. And we anticipate that to be about a week or 2 from now at the latest. And then my email, if you want to email me questions, is I have a support email address that goes directly to me and my assistant, and I personally read all these emails, and it's support@retiremebrad.com. That's support@retiremebrad.com, and that's how you get a hold of me.
Wow, fantastic information. Brad, thanks for coming into the podcast. We certainly appreciate you. Hopefully we'll see everybody on November the 7th and 8th in Addison, Texas for the Brad Sumrock Mentoring Rat Race to Retirement Multifamily Program, and we'll be there, and Brad will be there, and we'll see you then. Thanks, Brad.
Appreciate it, Paul.
Welcome to the Old Capital Real Estate Investing Podcast with Michael Becker and Paul Peebles. During this program, you will hear interviews with real-life successful investors who will share their stories and provide useful advice on how to acquire, finance, and operate apartment complexes. Now, here they are, Mike Becker and Paul Peebles.
Welcome to the Old Capital Real Estate Investing Podcast. I'm your host, Paul Peebles, National Underwriter for Old Capital. And of course, joining me today is Michael Becker.
Hey, Paul.
Michael, today in the podcast, we have a treat. Fritz has come down to visit us in the podcast, and Fritz is an underwriter for a Fannie Mae DUS lender that we do a lot of business with. And I want to kind of have Fritz talk a little bit about what's going on the Fannie Mae front, talk a little bit about underwriting. I think that's going to be very helpful for some people who maybe have never done a Fannie Mae loan, kind of understands a little bit of the intricacies, the ins and the outs of a Fannie Mae transaction. And then I really want to talk about servicing. And I think servicing is such an important point for people that own multifamily properties, and especially Fannie Mae loans, about what the backside of the transaction looks like. And it's not only on the front on the origination of a loan, but really what happens after the loan closes. How flexible is the servicing on the backside? So we're gonna start off with Fritz. How are you today?
Good. Thanks for having me, Paul.
No problem. Mike. So I thought we'd kind of talk a little bit about again, what is a Fannie Mae DUS lender? What does that mean?
Fannie Mae DUS lender we're a business partner with Fannie Mae. So it puts some private capital at risk prior to Fannie Mae. We're different. We're Freddie, for example, Freddie Mac. You have to go back to Freddie to get, most answers, almost like an FHA HUD execution, where on the Fannie Mae front, as a Fannie Mae DUS lender, they give us flexibility to close loans without even going to them, as long as it fits in Fannie's box.
So let me see if I can rephrase that. So you have a license with Fannie Mae, and there's only a few licenses that are out there, but you guys have one of those licenses.
Correct.
That says that you have been delegated, given authority on behalf of Fannie Mae to approve loans. So in anything that's up to, say, 80%, you guys have the authority within your company on behalf of Fannie Mae to approve a loan.
Correct. So
in a Freddie Mac loan, that typically does not have a DUS underwriter, that the loan has to be approved directly through Freddie Mac. So that's a little bit of the difference. So one gives you the authority, Fannie Mae gives you authority to approve the loan, and two, Freddie Mac reserves that authority themselves. So the transaction has to be packaged up, sent over to Freddie Mac. Freddie Mac has to approve it. That's pretty much the differences between the two. So I thought we'd kind of talk a little bit about underwriting transactions. Some of the people that listen to the podcast are not very familiar with what Fannie Mae does, and I thought we'd kind of talk a little bit about the benefits of a Fannie Mae loan. So Fritz, tell me a little bit about the benefits of having a Fannie Mae loan.
I think the number one benefit most people look at when they do a Fannie Mae execution is the non-recourse portion. So the only thing that the bank can come after, or Fannie Mae come after, is just the real estate. They can't come after your personal assets. I mean, barring any bad boy carve-outs or any fraud or any of that. But
Mike, talk a little bit about what bad boy carve-outs mean.
Bad boy carve-outs basically when you do the loan, like Fritz mentioned, it's non-recourse, so they can't come after your personal balance sheet, but they make you sign the carve-out, which says you will not commit fraud or misrepresentation, or you will handle the property and the funds ethically. And if you don't do that, then they can then spring in a guarantee under that scenario. But as long as you run the property ethically and, if something goes wrong, they can't come after you personally.
Okay, so let's talk a little bit about Fannie Mae and underwriting. Tell us a little bit about what you do when you underwrite a transaction. What are some key components that you're looking for from us to size up a transaction? Is it the operating statements? What exactly are you looking for the operating statements? Things like that.
Yeah, operating statements are key. A rent roll, a current rent roll. Those are the two major. Maybe if it's an acquisition, it's important to get a proposed budget from the borrower. When on a refinance, most of the focus is on the historical operations for expenses and such. On an acquisition, we'll look at the new buyer's budget and see, especially on a rehab property, what the improved expenses are. Whether say it's you get new windows and expenses will come down on the electricity and such like that. So we'll really focus on honing on the borrower's budget.
So what are some of the key things you guys are looking for? So when I present a property to you and I'm looking to you to tell me how much we can borrow, like what are some of the key metrics that you guys look for when you're sizing up the loan for the size of the loan dollars you can commit?
On an acquisition, we can go up to 80% leverage. And on a cash out refinance, we are at 75%.
So what other things? So we have the loan to value. What are the other things you're looking at when you're sizing up on how much loan dollars this property can support?
We'll look at the debt service, so how much net operating income you can produce and how much debt you can hold on the property. Usually it's 125 debt service coverage is the lowest Fannie Mae will go on that.
So let's talk a little bit about that too, because I think that's important about the leverage piece, is that we're based out of Dallas. Mm-hmm. We do transactions in Austin, San Antonio, and in Houston, as an example. But Houston is a pre-review market, which is a little bit different than Dallas is. And so when you have a market like Houston, what's the leverage difference, Houston versus Dallas or Houston versus Austin, as an example?
It's all the same metrics, Paul, but Fannie Mae, since it's pre-review, they want to have the final look. So while in other markets, our company has the opportunity to close the loan with Fannie Mae's, as long as it fits in the box. When it's a pre-review market like Houston, Fannie Mae has to prove everything. So for us to say, maybe we can get to 80% leverage in any market in Dallas on an acquisition, maybe in Houston, certain parts of Houston, Fannie Mae has a lot of exposure and they'll only go to 75%. It really depends on Fannie's opinion of the certain submarket.
Yeah, there's not a lot of pre-review markets in the United States. There's just a handful. But I think I wanted to make the point, because people do listen to this on a national basis, is that there are some markets that are pre-review, and talk with your mortgage loan officer to kind of figure out, is that the property you're looking at, is that a pre-review market or is it just in a regular market like Dallas, Fort Worth is, or Austin or Chicago or Denver? I mean, those are non-pre-review markets. Areas that would be pre-review would be Houston, some areas of Michigan are pre-review, some areas of Southern California are pre-review.
Ohio, the whole state of Ohio is except Columbus, MSA.
Yeah. So I just want to bring up that point. A couple things that I'm looking for is that when you do have a transaction sized up, we're looking for the operating statement for 2000, as an example, 2013, 2014, if you can get it on an acquisition, and year-to-date 2015. And then we're also looking for the most current rent roll. And in the rent roll, I just don't want to see it to be kind of handwritten. I want to kind of take a look at what the unit number is, how long the tenant has been in the property, how long the lease is going to be good for, the name of the tenant. I just want to make sure that in the amount and maybe the market rents of the property. I just want to make sure that it corresponds to the operating statement that we're looking at. But I'd also like to see a couple interior, exterior pictures of the property, kind of figure out exactly what that property looks like too. So that's probably just minimum information. And then if it's an acquisition, if there's a rehab budget to the property. Now, Fannie Mae has kind of cut back a little bit on doing acquisitions with the rehab, just because they've wanted to get all this rehab done fairly quickly within the first, say, 6 months of the transaction. They used to give us some more time, but they've started to pare back a little bit in the timing that it takes to get the rehab completed. So I think we'd like to take a look at just the initial rehab budget, and we also want to take a look at your pro forma and how you're going to run the property. If we give you the keys tomorrow, how are you going to, on a day-forward basis, how are you going to run the property? Are you going to run it at the expenses the seller's running it, or are you going to run it at the expenses that maybe are the realistic numbers that you can come up with? So I think those are maybe key things to put in there. Mike, anything to add with that?
Maybe talk a little bit about how Fannie Mae's recently changed over this year, some of the guidelines. And so what's kind of new out in the marketplace when we're out there coming to loan? If I got a loan with you last year, what's different today from, say, a year ago today?
I would say the one thing borrowers are noticing the most, their spreads have widened, even in the past year, and the interest rate. And a lot of that's due to Fannie Mae and Freddie Mac doing a lot of business in the last year. And Fannie Mae and Freddie Mac each have $30 million that they can, or $30 billion, that they can do in a year. And so it was about 6 months, so about June this year, and they've already been probably 3/4 the way through that $30 billion. And so the FHFA, who oversees the two organizations, kind of split off to determine what will count towards the cap and what won't. So anything that's rents that are 60% or less of AMI will not count towards the cap. So you're seeing a little skinnier spread in those deals. And then as well as the smaller units. So anything under 50 units do not count towards the cap. So you're seeing Fannie being more aggressive in those spaces. So maybe historically that, a Class A building that they really like, they're going to give a big pricing waiver on and get skinny on. Now they're not going to do that. Where on a C property, that's maybe rents are at 50% of AMI or area medium income, they'll be more aggressive on pricing.
So what are you thinking? So we're now September 1st as we record this podcast, so we probably have about another 2 months to get deals into this year. So are we anticipating when these loans are going to start closing in the first part of 2016 to kind of go back to normal, or is it still too early to tell from what you guys are hearing?
I think it's still a little too early to tell. Fannie and Freddie both haven't really been told what the new 2016 guidelines are, but it should be noted too that when it goes on Fannie and Freddie's record is when the security delivers to Fannie and Freddie. So usually say we close the loan December 15th, it usually won't deliver to Fannie until January, that same loan. So it'll count towards Fannie's 2016 number, not 2015. So it'll be interesting to see over the next couple of months as we start getting to those areas when we're going to be closing loans in December and it's going to deliver to Fannie in January, where they're going to come in on pricing. And that's the hard thing right now, and with all the regulation with Fannie and Freddie and with them being under conservatorship, they're kind of flying by the seat of their pants in some degree.
Sure. So the moral story, things are always changing, I guess. So what else has changed from 2014 to today, 2015? Any other material changes in the way the product functions? Besides, Paul mentioned that we have a 6-month rehab period if you have some renovations to it. Is there any other things that they've changed within their underwriting or guidelines or the way business is being done?
I would say with cap rates coming down primarily all over across the country, Fannie Mae has really pushed on the lenders to be a little more conservative on the exit analysis. So when we look at a transaction, say it's a 10-year transaction, we have to make sure at the end of the transaction that we're going to be able to refinance it. And so we have to run an exit analysis. And so in the past, maybe we've been able to, stress the cap rate by only 200 basis points or 2%, or maybe even less than that, maybe 1%. Now it's a pretty steady rule of thumb that you kind of have to have 2%. And we actually have our company as our lender assessment this coming month, and that's the thing that they're really hampering on this year, where maybe they've been a little more flexible in the past, but with cap rates coming down as much as they have across the country, that's one of Fannie's big sticking points.
So let's talk a little bit about exit strategy, because I think that's important too. Is that these loans are like Ron Popeil, set it and forget it. You don't have to usually come back for 10 or 12 years until you either sell the property or you refinance the property. But the lender has to make sure that at the end of going into the 9th year and 6 months, going into the 10th year, that they can get out of this loan, because they're not like a bank where they can just renew it automatically with the stroke of a pen. They have to make sure that by the time that this loan becomes to a maturity, that this loan has the ability to be paid off. And so what they do is they stress out the transaction. They stress it out by having so much of a percentage of income go up and so much of a percentage of expenses go up. And what they're thinking is what the valuation is of the product at the end of the 9th year, 6 months, going into the 10th year, or what the value of the property is going to be at that period of time with these expenses and income rising, hopefully, in the transaction. So where you may think that you can get a 10-year loan, sometimes having problem with the exit strategy can sometimes prevent you from getting a 10-year or even possibly even a 12-year loan. So talk a little bit about that. Does that come up very often, or do you just go with some maybe to satisfy that lower leverage in the deal? Would that be one of the things that you would focus in on?
Yeah, so Paul did a nice job kind of explaining that. So usually we'll raise expenses 2% a year and expenses by 3%. And at the end of the term, as much as we like to think that interest rates are going to stay sub 5 for forever, we love that to happen, we have to stress it at 7.5% and increase the cap rate up 200 basis points. And the big things that where it comes into play a lot of times when we look at an exit analysis is when, say, on an acquisition, you're looking for interest only. It's important up front to get, 1, 2, 3 years of interest only. And it's important when you add that interest only, how it exits. And that becomes a big question on how much interest only you can get on maybe an acquisition or a refinance.
So if you have 2 or 3 years of interest only, you're not really changing the balance of the loan. In fact, it's just, it's staying the same.
Yep.
So you need to take a look at on year 10, if you're only making 7 years and making payments, what the balance is of the loan at that period of time, and can we have this loan paid off? Can somebody come in and either refinance that loan at that period of time, or can somebody acquire this property and make sure that we can get out of this loan? Because there's not, in the Fannie Mae rule, there's not a 10-year, 1 day. That loan has a hard maturity, has to be paid off if it's a 10-year term.
One of the things I think is important that you kind of made crystal clear in my mind here is that we've seen prices go up quite a bit, cap rates are compressed, interest rates are down, but rents are up. And through all that, it seems like the two largest lenders, Fannie Mae and Freddie Mac, are keeping their underwriting guidelines still pretty tight. So we aren't really out there like we were 10 years ago, wild with our underwriting guidelines. So the market still seems to be pretty healthy in my estimation. So I don't know if you have any sort of thoughts on where we kind of are from a macro standpoint on the market with, how the lenders are looking at things. Does everything seem like it's still within reason, even though, prices are up and rents are up and cap rates are down? What's kind of your general take on what you're seeing out there?
Yeah, I think Fannie's been pretty conservative still. I think a lot of this is more on the macro side is people are renting more than they ever have in the past. Home ownership rates are the lowest. I think it's 63% people own homes, where usually more in the 2005, it was more 70%. And it's almost a demographic shift. I'm a younger guy, and I would say most people when they graduated college would go and they'd buy a house, get married at 24, 25 years old. And nowadays, they're living in apartments till they're 35 and buying the house then when they're ready. And a lot of that's student loan debt, and it's really a bigger macro situation. But in terms of the underwriting guidelines, I don't think we're really stretching. Sure, I think, interest rates are lower historically, and, cap rates are lower and prices are going up. But it doesn't feel like people are really stretching too hard. I think the market's strong, it's stable, and I think it will be in the future. It's like you said, it's different than it was in 2005, where you're really leveraging properties up and really pushing the exit. I think we're being much more conservative.
When somebody does a Fannie Mae loan, what can they expect for third-party expenses? And where does that money go to? So how much money do we need when we do a Fannie Mae loan? How much does the borrower have to pay?
I would say for the third parties, it averages out to be about $10,000. And it really depends on, where the property is and how quick the turn is. I mean, say you have an acquisition and you have to close in a month. And usually the biggest lag time is the third parties. So say you get a 2-week turn on the appraisal, where normally you can get it for 3 or 4 weeks. The appraisal will go up, price of the property condition report in phase 1 will go up as well. So a lot of that is due to timing, but generically, I would say around $10,000.
Okay. So the $10,000 goes into the third-party reports, which is an appraisal, determines value. Second one is a property condition assessment report, which is an engineer's report that really takes a look at two things. What's the health and safety of the property? Is there anything that has to be immediate concerns on the property that has to be fixed or cured? And that property condition report also tells us, a property is like a living person. How much more money has to be put into it on an annual basis? Is it $350 a year? Is it $400 a year? Is it $450? How much money has to be put into the property to keep it going? And the third report is a phase 1. So figure out what lies below the surface. If there's anything that is above the surface, like maybe 55-gallon drums of diesel fuel that's been stored. These are just crazy things, but the property condition report and the engineer's report and the appraisal is kind of the eyes and ears of Fannie Mae to kind of determine, what's their risk level of getting into this transaction. Some of the things that we also have to include on a Fannie Mae loan is attorney fees. So an attorney who represents Fannie Mae is going to charge anywhere from $9,000 to $12,000 in attorney fees. So just be prepared for that. And the loan documents typically are not negotiable loan documents. Maybe there's one thing or two things you want to change, but these are kind of these. You have two choices. One's take it. Second choice is leave it. So you really don't have a chance to kind of change up the loan documents on our Fannie Mae loans. Kind of like your home loan that you just can't strike stuff out that you don't like to see in there. And then typically, how long is it going to take to close a Fannie Mae loan?
I would say 45 days.
Yeah, 45 days. Now, Fritz just closed a transaction with us. In how many days, Fritz?
Maybe a little over 30 days.
30 days. So that's highly unusual. The wins were in our sale. Fritz was very proactive in the transaction. The borrower was very proactive. But it can be done. So, you don't want to put every transaction within 30 days. Stick with the 45 to 60 days and under the financing contingency.
Yeah, maybe kind of moving on the life cycle of a deal. Tell us a little bit about servicing. So what are some of the things that a borrower should expect from servicing with a Fannie Mae loan, and how is that a little different than just like a traditional community bank loan? Maybe kind of talk about that a little bit.
And what is servicing? What does that mean?
So when you do a loan, you talk to Paul or Mike. They'll contact us, and you'll deal with me on the front end for maybe a month or two. But I think it's important as we start to begin to talk about servicing is those are the people, it's usually a 10 or 12-year transaction. The servicing folks are the people you're going to deal with. And so on the servicing side, there's someone that will, for our company internally, will manage your loan and make sure you're making your payments. And we'll manage, say, your replacement reserve. Say you are going to update the carpets or do some repair and maintenance. That's really more capital expenditures. You'll take a picture of it, send it to us and we'll send you some money. That's kind of how it works.
Do you have to put the money up front into the transaction and then you're reimbursed for the transaction? So to give you an example, like if you need to replace flooring and it's $15,000 worth of flooring, do you have to come out of your pocket for $15,000 and then you get reimbursed the $15,000, or can you just send them a purchase order for $15,000 and the servicing company will write a check out to get it done on the front side? So do you remember how that's done?
So I think, Paul, it's a little bit of both, right? So if you have the capital that builds up through monthly payments into your replacement reserves, and you have a big co-payable check, the money in your account, sometimes they'll cut a check to both the borrower and the vendor, and sometimes if you paid for it, you just submit proof of payment, and they can reimburse you for that. So,
why is it important to, with your company, you are not only do you originate the loan, but you also service the loan? Why do you think that's better than somebody that sells that servicing to a third party?
I think it's easier to communicate, and it's important. Say we have a relationship with one of your clients, or it's important for us to manage your servicing over the life of the loan. We want to keep that relationship. It's important to us.
Yeah, I think why that's so important is that the transaction really on the front side is like the top of an iceberg. You just see like 1/7 of the iceberg above the water, and that's the origination. The 6/7 that are below the water is the relationship that you're going to have with the servicer for 9, 10 years or 11 years or 12 years. And it's important to be able to have some give and take. So when the origination company also services the loan, I think it works much better than somebody that sells their third-party servicing. Just because you guys have the flexibility to do it or not, the third-party company that does it independently, they have to keep within the rule of what's on the paper and what's written. So sometimes they are inflexible than what the reality is when you own an apartment building. Anything to add with that, Mike?
No, yeah. Maybe talk a little bit about what are some of the common things that you see people make mistakes on when they're getting their first loan or their second loan. So what are some of the things inexperienced borrowers do wrong that maybe you can shortcut for them?
Do wrong. We don't like any borrowers that do anything. No borrowers do anything wrong for us.
Well, how can they make the process go a little smoother? Maybe what are some of the common things that cause delays, or maybe some miscommunications along the way? Maybe you can give a little tip to shortcut for some people.
I would say get most of your documentation. Get your ducks in a row up front. So make sure all your reports are ready. Get all your operating statements, rent rolls. Get all the historical stuff ready. Maybe your balance sheet, your schedule real estate owned on the sponsorship side. Those are the things that I think if you have all that organized, it makes the process a lot easier. If it's kind of in a scramble and it can prolong the loan process.
And a lot of people that listen to the podcast maybe have never done a Fannie Mae loan, and may have never done a multifamily loan because Fannie Mae is only for multifamily. But let's say the person that's listening to this podcast that's never done an apartment loan. How difficult, if you've never done an apartment transaction or had ownership in an apartment transaction, how difficult is it to get a loan with Fannie Mae?
I think it's not difficult, I would say. I wouldn't say it's impossible. I mean, they're going to want to see that you have some experience owning real estate. They want to see that. Generally, the requirements to be a sponsor on a Fannie Mae loan is you have a net worth that's equal to the loan amount, and you have liquidity, where that's cash. 401k in some situations, that's 10% of the loan amount. Those are kind of the general guidelines to be a sponsorship on for a Fannie Mae transaction. But it's really, they're going to look at your experience on owning apartments and managing them.
Mike, talk a little bit about how we work through that.
Yeah, so if you don't have experience, you're definitely going upstream, so it'll be a little bit more challenging. So usually you would need to either bring another team member on that has previous multifamily experience and kind of build out the resume of the group, because it's not just the net worth and liquidity requirements aren't just on the one person. So if one person doesn't have it, they can have 2 or 3 other people join them, and it could be an aggregate of a pool of guarantors. So that's kind of some of the ways you can get around this, is just bringing someone else in on your team to sign on the carve outs with you to kind of meet those general requirements.
And that person that's coming in, that person, if you don't have Fannie Mae experience or multifamily experience, you want to have that person you bring in have the Fannie Mae or multifamily experience. They've owned a property in the past, or it's been the same size in the same submarket that the property that you want to buy in is in. Now, I wouldn't call those people a gun for hire, but I would think they're pretty close to a certain extent that you're bringing in and we're keying off their experience piece. The biggest thing is that we don't like to have these gun for hires come in and not bring anything to the table. We would prefer for them to bring in equity into the deal. Now, it's not required, but we prefer it. I think it's easier for us to underwrite the transaction when somebody has some skin in the game. Similar, I can't tell you exactly what that number is, but Mike, what's your...
What do you have a kind of a loose rule of thumb on the amount that the people signing on the bad boy carve-outs need to put in equity in the deal? Is there like a minimum number that your firm requires?
We don't, in terms of you can sponsor to be a key principal. We don't. The general requirements are if someone owns more than 25% of the borrower, then we'll have to underwrite them as a key.
But you guys don't like it when the people signing the carve-outs don't have any dollars in the deal, right? So
Correct.
You typically want them to have 5-10% of the overall capital in the deal as far as a cash contribution, correct?
Yeah, they're not just gun for hire.
Yeah, the Fannie Mae is doing these non-recourse loans, which really means that they're not taking an interest in your personal financial statement. They're taking an interest in the collateral. And how they mitigate that, I think is additional risk, is by putting their faith in the experience level of the person who's owned a property in the past or has financed a multifamily property in the past. And so we want to make sure that person who's coming in to kind of sponsor you, I kind of call that the country club sponsorship, because if you can't get into that country club just based on your own merits, maybe somebody can come in and sponsor you, and that's kind of what we're looking for, is that if you don't have the experience, that group can sponsor you. So we want to make sure that sponsoring person has some skin in the game, for one, and two is that is knowledgeable, about managing and owning a multifamily property. So I think that's probably what we're looking for.
Yeah, maybe one of the last things we talk about is more and more, a lot of people put Fannie Mae loans on 2-3 years ago when the prices have gone up. So what Paul and I are seeing are more and more assumptions, and we just did an assumption with you guys last month. So maybe just talk a little bit about the differences and some of the things that you need to think about when you go in to buy a property that has an existing loan on it that needs to be assumed. So maybe you can talk a little bit about that and some of the differences between that and new originations.
Mm-hmm. It's a little bit of the same process, but the big thing when you do an assumption loan is to see how much time is remaining on the loan. If it's more than 7 years remaining, we can do an assumption and do a supplemental up to 75% of value. And then again, just as strictly a supplemental, if you want to do a cash out supplemental on top of, you want to take advantage of the improved property and take some cash out, we can go up to 70%.
Maybe talk about what's a supplemental, maybe define that a little bit.
So a supplemental is just a second mortgage on the property, so on top of your first mortgage.
So if there's the Fannie Mae rules, as long as there's at least 5 years of term left, you can do a supplemental loan, right? But as long if there's less than, there's between years and 5 and 6 left on the loan, then you guys ratchet down the leverage a little bit and shock the interest rate test a little bit higher, correct?
Correct. So we have to underwrite a higher interest rate, and the leverage goes down to about 65%.
So there's a couple of things that came out of there. A supplemental. So the first lien, when we do a brand new loan, that goes on the books. And after 1 year and the property is doing well, in fact, it's doing much better than what it was when we originally had done the loan, Fannie Mae allows us to come in and do a cash out, refinancing the property. If it's a cash out, we're at 70% leverage. And if it's somebody that's wanting to buy your property and they want to put that's second lien against the property to get the higher leverage, we'll go up to 75 on the deal. Now, I think that's a little bit of a difference from, say, FHA loan or a CMBS loan, is that not only can you set it and forget it, but you can go back and take some additional cash out, a second bite of the apple with the supplemental on the loan.
Yeah, that's pretty a unique feature to the Fannie Mae and Freddie Mac product that's not really widely available in other products out there. So I think that's an important thing to know, and why we, when we're looking at deals, we prefer, generally speaking, to go Fannie Mae over, say, a CMBS loan. So any other kind of last thoughts to wrap it up on what people should know about Fannie Mae or anything kind of related to multifamily lending?
I think it's going to continue to be strong for Fannie and Freddie both. I think they continue to do a lot of business, and it seems like a pretty smooth process. Our borrowers seem to like it. But again, I think the servicing side, as we talked about for a while today, is something to really focus on, because when you choose a lender, it's almost like you're choosing a business partner, just like you choose your equity partner. And throughout the life of that deal, at least for 10 or 12 years generally, that's the person you're going to be working with, and that's the company you'll work with. So make sure you focus on that.
I think you're absolutely right. And we have a great relationship with Fritz and his company. We've done several $100 million with Fritz and his company, and we have a very good working relationship with them, as Michael does too. And we appreciate your help, and we appreciate the hard work that you guys have put into every transaction. Not every transaction is going to be a Fannie Mae loan, but if it fits your box that you want to get a loan that's going to be kind of for a legacy asset, that you're going to hold the property for a long period of time. You're not going to hold it for 2, 3, 4 years, but you're going to own it for 10 or 12 years. A Fannie Mae is pretty much the right execution to get it done at pretty much the cheapest price point and has the greatest amount of flexibility. So, Fritz, we appreciate you coming in today. Mike, anything more to add?
Thank you so much.
Yeah, thanks for having me.
Okay. Thanks, Fritz.
Thank you for listening to the Old Capital Real Estate Investing Podcast. Please join us at oldcapitallending.com to sign up for our weekly email updates. We'll see you here next week with another great interview.